It might seem an obvious thing to say, but human beings don't like losing money. We really don't. Behavioural scientists refer to this tendency as loss aversion.
Loss aversion is the fact that given a loss and a gain of equal value, the loss hurts more to us than the gain feels good. Some people are the other way around. Those are risk seekers, but most of us are loss averse, which generally means we don't want to put our money at risk. And that really hurts us when it comes to investment, because in order to outpace inflation, which is the whole point of investing in the first place, we have to take on some risk. Otherwise, we won't get the return that we need in order to outpace inflation.
Investing is inherently risky, and you shouldn't take more risk than you need to, than you're able to, or you're comfortable with. But most people are programmed to take less risk than is actually sensible.
A simple example is that when a group of people were given a bet of the chance of winning £2,500 against the potential loss of £1,000, they needed a better than 50-50 chance to take that bet on. Now logically that doesn't quite make sense. You've got a 50-50 chance on the coin costs, and you've got the potential of a much larger upside than the downside. So it should be a fairly simple decision.
Ironically, one of the biggest risks investors take is not taking enough risk. They spend too long with too much of their wealth sitting in cash.
If you think about a moderate risk investor who would be otherwise invested in a nicely diversified multi-asset class, equities, bonds, cash, bit of everything in there, not too risky, moderate risk portfolio over the long term, you should expect to get over very long periods of time returns in excess of cash of about 4.5% to 5% from that portfolio. So if you are sitting with portions of your wealth doing nothing for long periods of time, you are effectively buying yourself the ability to get to sleep at night at the cost of 4.5% per year. Now that is an extremely expensive way of buying emotional comfort for yourself.
Another example of risk aversion is the way investors take fright when markets start falling. That's when our survival instinct kicks in and we naturally want to protect our money.
We've got a portfolio, it falls by 10% or 20%, whatever the number is, and we think it's going to fall more, it's going to keep on falling. So the instinct is to sell up, hold it in cash, and then don't worry, I'll get back into the market when things are better. It's the wrong thing to do. Timing markets is incredibly difficult, and therefore selling when the markets have started falling is a dangerous strategy, because the chances are by the time you've got that optimistic feeling back, markets have recovered and you'll be buying in at a higher price to where you sold out.
So how do you combat loss aversion? Well, first things first, you need to accept that for all equity investors, market volatility comes with the territory.
What you have to acknowledge as an investor is when you invest in stocks, there's going to be volatility. There's going to be tough times, there's going to be good times. Set an asset allocation that you can live with, that has a good balance between stocks and bonds, so that you can ride out those tough times, stay disciplined during those good times, and then stop worrying, because markets are good at pricing information, they're good at setting themselves up to have positive expected returns, but things that are unexpected always happen, and that causes markets to go up and go down.
And here's another tip for those prone to loss aversion. Don't check your portfolio too often. Just once a year is perfectly sufficient.
Almost all of us are myopic. We look at things in too short a time horizon, and we are granular. We look at the detail before we look at the big picture. Always flip that around. Whatever you're doing, try to look at the big picture first and then go to the details if you have to. And always try to look at the long term first and then look at smaller time slices if you have to.
So accept that market volatility is perfectly normal, don't keep checking your portfolio, and focus on the big picture. Over the long term, patient investors have tended to earn handsome rewards for the risk they take.